1 second. Have to turn the light on. Hello, everybody. Oops, let's just fix that. Welcome to the Thursday evening financial thing impromptu live stream sponsored by Cufflink, gracious sponsor of the show. Let me know that you can hear me okay. I was having a little audio issue with the computer earlier. Hopefully it's okay now. Yeah, it's going to be a short stream. I have to finish packing and get to the airport in about 3.5 hours to head over to Blighty. That glorious 8.5 hour flight crammed in a sardine can next to 350 of your closest friends and kids coming back from Disney World. You know what that means. Babies crying, people hitting the touch screen on your headrest. You know, they put those touch screens now in the back of your headrest, so people with really heavy fingers always seem to sit behind me, and they're pecking away. You ever experienced that? They're pecking away at that screen, and your head's going boom, boom, boom. It's just part of the joys of air travel, unless you have the financial ability to get those beautiful first-class seats, which personally I don't do that. I just can't justify that kind of money to sit on a plane for 8.5 hours. I suck it up, do the economy, have to take the consequences. But anyway, I digress. So, yeah, real impromptu stream today. I don't have a whole lot that I wanted to go through, but a couple of bits of news. I'll be heading off to the Cufflink HQ tomorrow morning, so I get off the plane and take the train to Gravesend to the Cufflink headquarters. No sleep, all for your entertainment, content value. We're going to go see them. We might shoot a couple of videos over there. So I'm going to do that tomorrow. And possibly see somebody else when I'm in London. I know I'm going to be catching up with LoanPad to maybe Planned. I don't know. But so that's happening tomorrow on Friday. What else? Yeah, I just want to thank you. So we're kind of at the end of the 6 months of 2023, which is crazy. And I wanted to thank you for just consistently being here and supporting this stream and the financial thing channel, and all those times you've hit that thumbs up button for me. I appreciate that, every single one of you. All the Patreon members, we've had some Patreon members that have been members now for 18 months, and it's just really heartwarming to me that you guys have continued to support and be here. So I just want to say thank you, since we go into the last half of 2023, which is just crazy. It feels like 2023 just started. And we'll continue, I will continue, me on myself, to provide you with this content and to really try to dive into peer-to-peer lending as much as I can, to continue to bring you the founders of the companies right here live, to do interviews and give you information about, the companies and the places that I know you invest, because I know a lot of you invest in the same places that I do. And by the way, if you have not seen the new video that I have posted, go check it out. It's right down here on the videos. Paul Orger, COO, Chief Operations Officer at Cufflink. We've done this half an hour video. It's really informative about how Cufflink screens and approves its loans and the entire process that they go through to do that. It's a really good behind the scenes look. Also, if you click on the live link, you're going to see all the Q&A sessions that we've done over the last years. This has been going, for I don't know how many years now. But yeah, if you want to check out those Q&As going all the way, all the way back, you can also click on the playlists here, which is a handy feature on the channel. So right here, there's a Q&A playlist. I don't know why it's showing. Yeah. there's a Q&A playlist on here, so you can go check that out. Lots of really, really good content that is there for you guys to enjoy and to get knowledge. So that's news. And I'll be back on, I think I'll be streaming the first week of July. I may do something when I'm over in the UK. I don't know. Who knows? Maybe we'll go live at Cufflink tomorrow. I can't promise anything because I'm trying to take a bit of a break, but I might throw up an impromptu live stream in the next couple of weeks. But if not, back in first week of July. And yeah, it's exciting. So happy to do it for you guys. See, well, since we haven't done a regular stream in a while, we'll say hello to everybody who is here. So we got Invest 22 in bright and sunny London. I heard it's going to be a very balmy 30 degrees Celsius tomorrow, so no rain. Happy about that. Mike Powell in Southampton, Colin Perry in the Peak District, Paul Bagworth in a lovely Kenilworth, David Dawson, of course, in Stoke-on-Trent, Peter Vince, evening from Leatherhead, Stephen Helling in Nottingham. So welcome, welcome. The high pressure is over. Hopefully it's not too hot. I know you tend not to have too much air conditioning over there, so I've gotten a little spoiled with that here. But anyway, let's take a look at some news. We're going to talk a little bit about the FCA crypto regulation, not too much, but I'll touch on that. And then I want to show you the Trading 212 portfolio, which has been doing a lot better over the last couple of weeks. So I'm going to give you a quick snapshot of that and show you what I purchased on there. You zoom in just a little so you can see this. This is an interesting story from Assets Exchange, who says that 7% yield is the sweet spot now for peer-to-peer loans. 7% is the sweet spot for P2P lending yields in the current high interest rate environment, says Peter Reed, director and founder of Assets Exchange, who also was on the channel on May 25th right there. There's my SodaStream bottle. Don't know why they chose YouTube to pick that as the thumbnail. Maybe that's entertaining, but yeah, go check that out. It was a couple of weeks ago, a really good chat we have with Peter Assets Exchange. Following a series of Bank of England-based rate hikes, Peter noted that peer-to-peer platforms are now competing against FSCS-protected cash savings and cash ISA accounts, which are offering returns of up to 5%. In order to remain competitive, many peer-to-peer lenders have increased their lending returns, including Assets Exchange. Yeah, we've seen that happen quite a lot recently. We're getting these rate bump emails. LoanPad also increasing their rates. Crowd Property increasing their rates. Even Unbolted increasing their rates. So, by the way, still trying to get Unbolted on the stream, hoping July we will absolutely be able to do that. So I did have an interview with Unbolted somewhere, but I just can't seem to find it. I don't know if it was on the old channel or if it got deleted, but yeah, Unbolted hasn't been with us for a long time, so we're going to really try to get Ashwin, one of the founders, on here in July. Anyway, Peter has realized that in order to stay competitive, the Assets Exchange had to increase their yield significantly. People want to get that premium, so we launched 2 properties in January at 6% net yield and 1 in March at 6.5%. Then in April, we listed a loan at 7.5%. That was our fastest selling loan ever. When the yield is above 7%, it seems that people are more likely to invest. A number of peer-to-peer lending companies have increased their rates above the 7% mark. Folk to Folk increased its target returns from 6.5% to as much as 9.5%. Just Us raised its rates by 0.5% in February. Cufflink increased its target rates to 9.73% from 8.05%. And then Unbolted increased its lender rates from 8% to 9%. So very beneficial. I mean, if you're a lender, obviously you want to see competitive yields. And I just went to Money Supermarket because I was curious about exactly what rates you can get at the moment if these savings rates have really increased. And I'm getting about 3.8% in Ford at the moment. But let's take a look real quick and see. Now, of course, you can get these 1-year fixed bonds here at 5.3%. They're not your usual high street banks. You got Al Rayan Bank, National Bank of Egypt, Investec Bank. So these 1-year rates really lock you in. You got some minimums here. This one's a minimum of 10,000. So I've always been more of a fan of the easy access because honestly, really the difference between say what you can get at Aldermore or Sainsbury's, leads at 3.75%, and then having these fixed to 5%, you're talking about 1.15%, and you're locking your money in for a year. And I just think these interest rates, I do believe, are going to actually go up again. So I reckon these will go to 4%. So the difference between 1% to lock your money in for a year and 3.85 to 4% to get access instantly to your money, I don't think it's worth it. So personally, I just stick to these instant accesses, and as those rates start to increase, they will become more competitive. So when these peer-to-peer lending companies have increased the yields that they're offering to you as an investor, it's sort of making that bridge gap more attractive to get 9%, 7.5% to 9%. In some of the companies that we've been investing in for a while, it's definitely way more attractive. You are taking that extra risk, so I think you're being paid, to take that extra risk. You're doubling what you're going to get in a FSCS protected savings account. Obviously, you have to bear in mind that you're not protected, but to get double the interest, I think that's a very reasonable ask from a lot of the peer-to-peer lending companies. So it's good to see them, all of the companies looking at their rates and going, how are we going to keep investors interested in our products? Because honestly, if they don't increase those yields, and they're staying in that 5.5%, 6% rate, it's really sort of a tough sell. And especially if you're a new customer, you haven't invested before, you're probably looking at that going, yeah, 6%. I have to take risks with a company I'm maybe not familiar with versus I can go to Aldermore or Leeds, get 3.75. They're probably just going to stick to the banks that they know and have heard of. But I think the peer-to-peer lending companies have to offer these more attractive rates to get new customers. As Peter Reed said last couple of weeks ago, biggest challenge for them is getting new customers. You're competing against all of the other investment products out there: stocks and shares, cryptocurrency, savings account, bonds, premium bonds, which I'm not a fan of. But you got to compete against all these different sectors. You have to be able to offer attractive interest rates to bring in those new customers so you can expand as a company. Let's see, peer-to-peer regulations were dry run for crypto regulations that we've seen. The FCA drop some new cryptocurrency regulations. The peer-to-peer industry stakeholders believe that the sector's recent financial promotional rules were a dry run for the newly announced cryptocurrency asset marketing restrictions. One peer-to-peer stakeholder, who asked to remain anonymous, said that the financial promotion rules introduced for the peer-to-peer and crowdfunding sector were 100% dry run for the new crypto marketing regulations. The new regulations for crypto assets were announced June 8th, that's today, and require all crypto firms to introduce a cooling-off period for first-time investors, mirroring the recent financial promotion rules for high-risk investments, which covers peer-to-peer lending. The new crypto regulations ban refer-a-friend bonuses, and all crypto firms are now required to put in place clear risk warnings on their website to ensure the adverts are clear, fair, and not misleading. All this is going to do is drive the product to the mass affluent offshore investors. It's an ill-informed judgment. A representative from the UK Crowdfunding Association agrees, saying, "This has always been the plan. In a way, the risk of crypto was driving the development of elements which we feel in aggregate go further than the original objectives of this change." It'd be nice if they could just speak English. I don't know why people feel they have to make complicated sentences like that. I am but a simple man. In other words, the fear of potential and actually customer detriment related to crypto has pushed peer-to-peer and crowdfunding into the regulatory regime, which is now the toughest in the world. Whatever your opinion of crypto investments, the UK CFA feels strongly that there's need to review these impacts of these rules on a sector which is very different in both regulatory status risk to investors. So this is something we've heard on interviews, which is peer-to-peer lending company reps are saying, peer-to-peer lending should not be grouped into cryptocurrency, which is where they both stand, because they have very similar rules about marketing now, this ban of financial promotions, this cooling off period now, which the cooling off period is 24 hours from, the way that the FCA described it, I think I pulled it up. So I close it out. I don't know. Here we go. I was reading through the regulations about the cooling off period for crypto now. We will clarify that the 24-hour cooling off period starts from when the consumer requests to view the direct offer financial promotion, which I thought was banned anyway. So firms can proceed with other parts of the consumer journey while the cooling off period applies, such as know your customer and anti-money laundering checks. If these other processes take more than 24 hours to complete, firms will not need to introduce an additional pause in the consumer journey. However, the consumer will still need to give their active consent that they wish to proceed with the investment. Do these rules really help the consumer? I have to ask. Cryptocurrency is a very specialized niche form of investing, like peer-to-peer. You're not going to get that many people that just blindly run into crypto and start just buying stuff. They've probably done some amount of research and some amount of reading. You're not going to get Grandma Joe fiend on Coinbase just plodding away and buying stuff without doing any research. It's probably just not going to happen. So do these regulations that the FCA have put into place really help consumers? I would go to say that, in my opinion, it's more of a regime tighten crackdown on a system that the government cannot control. And this is what it's always been with crypto and Bitcoin, and its separation and independence is how can the government control something that's at least for Bitcoin, is very independent. This is the way they can do it. They can try to really put the clamps down. They can get rid of the onboarding platforms like Coinbase. You've probably seen in the news both Coinbase and Binance have been sued by the the SEC in the US. They continue to want to clamp down on these free choice systems, which I'm a big free choice guy. Is there a cooling off on a bet on betting? I don't know. I'm presuming not. And I think one of my biggest gripes is I want things to be equal across all these different types of things that consumers can do. So you have free range. I presume you can walk into a casino and make a bet. I know there used to be a 24-hour cooling off period about when you wanted to sign up for a casino. I don't know if that still is applicable in the UK or not. I remember when I was 18 or 19, I tried to get a casino membership and they said you got to wait 24 hours. I don't think it's like that anymore. Betting, I don't know whether it's like that. I'm presuming not. So there is really no equality when it comes to these different things that the government and these government-tied organizations try to regulate. And I just want to see some equality. If you're going to make regulations on crypto and on peer-to-peer, then you got to make it on sports betting. Ladbrokes, the betting shops, and all these different places, and stocks and shares. It could be said that stocks and shares are completely as gambly as this cryptocurrency stuff. You've seen some of the things on my trading 212 portfolio, which are down in the red by big amounts, right? I've had stuff that's gone down 50%. One could say that's just as gambly as cryptocurrency, or is definitely way more gambly than peer-to-peer lending. You have all of these thousands of different shares that you can pick out. You have no idea what they are most of the time or what they do. And yet no cooling off period. Trading 212, there's no cooling off period if I want to open an account and punt my money off to Calera shares or some £1 stock based in under a volcano in Africa. There's no cooling off period. So there's no equality, and I just think that's the thing that irks me the most about these regulations and rules that get into place. I would have no problem if they were put into place across gambling, across betting, across stocks and shares, but they're not. They're targeted towards certain things that, for whatever reason, usually money and power, they're targeted that way. And it's really frustrating, but it is what it is. Cooling off period is just one time. So when you open an account, if you want to buy your investments after that, you're fine. You can do that. There's no cooling off on trading on cryptocurrency, which I think is, thank God they didn't try to do something serious like that. Anyway, that was my little rant. Back to it. Folk2Folk reports fourth year profit and recommits to retail. There is Roy Warren. You remember we had Folk2Folk 2 on the stream right here back about a month ago. You can go check that out. It's on the channel right now. But they have reported a really big pre-tax profit of $1.37 million in the 12 months ending 31st of January 2023. This compares with the profit of $1.96 million during the previous 12 months. So they're doing really well. That's a good result. I think they've had some challenges, as I think everybody has in the institutional lending, and within lending, I think in general, it's been a difficult year. But they've done actually well. They've adopted a more flexible working model. Their team is pretty small, so I think they keep their costs down, and they are committed to, focusing and supporting the retail investor, which is really good. We've seen a lot of companies recently stop supporting the retail investor, so peer-to-peer is going to continue to support the retail investor. We'll see if that remains to be true. I believe it. There is Narinda. Cufflink tightens its loan management process. They've tightened their process by engaging more closely with the borrowers. They have engaged a legal law firm that specializes in mortgage and debt recovery to contact its borrowers before loan end date and explain the redemption process. I think that Cufflink has definitely seen more and more loans that have gotten extended out because that's just part of the nature of bridging and development lending. But they are trying to hone that in and to maybe get some help to maybe put a little bit of heat on the borrowers to say, hey, this is what we got to do to get these loans into good order, or even just make that time frame a little bit shorter so maybe there's not as many extensions. Our aim is always to work towards the loan being repaid within the original term, but we fully appreciate there'll be circumstances when it'll be necessary to consider a reterm. You probably see those emails come in when they do that. If we're willing to consider this, we may also try to ask the customer for capital repayment to reduce the loan balance, provide us with proof of the final exit strategy. So it's good. It's good that they recognize maybe areas that they need to improve on. Maybe that is one of the areas, obviously. So I'd like to see that kind of accountability from companies where they can see an area of improvement and they go ahead and attack that. Relendex has raised £3 million from private investors. The lender will use this cash injection to support its growth in the UK. The company has raised £3 million in 2023 from private investors to ensure it has the capital base to support its growing loan book. Company profits exceeded the $322,000 profit that was reported last year. Peer-to-peer Finance News understands that 2023 profits were in the $300,000 to $400,000 range. I don't really know too much about Relendex. It's a company I would like to actually get on the stream and just learn a little bit more about. I don't know if any of you do invest through Relendex, but I always find it interesting that they do these capital raises, and I just wonder how they're going to pay these people back. You know, if you're making $322,000 pounds profit every year, how do you pay back $3 million raised from private investors? Is there ever a goal to repay those shares? I don't know. I don't know how they pay those things back. I mean, you got to be making some serious profit. If you're making $1 million, you still can't take that entire $1 million, pay back investors. They're probably going to take a portion. So it's going to take a long time to repay that money, which is why I always get a little reluctant to invest in things like Cedar's shares, even though, yes, there's liquidity on the market. But I was trying to think about what's the game plan to pay back all this money that's borrowed to fund the company. You know, because you can't keep borrowing and borrowing and borrowing. Eventually you got to pay people back. Otherwise, they're not going to lend to you anymore. So there you go. Peer-to-peer firms poised to provide development exit finance. Yeah, well, let's skip that story. It's boring. I got this email. I said short stream today, so I'm going to skip through. I got this email from Funding Secure saying, unfortunately, the platform will need to be frozen in order to finalize the terms. In order to finalize the details of some further loan repayments, a further update will be posted as soon as possible. So I go on Funding Secure's website to try to log in earlier. Let's refresh, but right now it says Funding Secured is down for maintenance. So is it still down? It's kind of a little, I don't know. I don't like to see this for several hours, so I'm wondering what's going on there. I don't know anything, to be honest. I don't know if there's an issue or not, but that's happening. Crowd Property is funding £16 million of gross development value in a Bradford scheme. That's pretty cool. Specialist residential property development lender Crowd Property is supporting a £16 million gross development value project in Bradford, which will see construction of 137 apartments on a site which previously used as Hallmark Cards manufacturing facility. That's pretty cool. I laugh because I gripe about Hallmark. It's so silly, right? I just find Hallmark Cards to be such a ripoff. I don't know if you've noticed how much Hallmark Cards are these days, but maybe like, £3 to £5 for a stupid greeting card. And you can literally go to the pound store or the dollar store and buy a card for £1. Are they as nice? No, they may not have all of the glitter on it, but it's a card, right? You know, and the worst thing is, you know how they get you to pay the expensive price is because they put the price on it on the back of the card. And you're always afraid that somebody's going to flip it over and see that you spent £1 on that card versus like £3 or £4, and you think, oh, they're going to think I'm cheap because I didn't buy a Hallmark card. Anyway, rant over. Crowd Property has agreed to a total development finance facility of $9.25 million over 18 months, enabling this unique development that involves a building with a rich history. The developer has already delivered and successfully sold the first phase of the development on the site, which saw the conversion of a main Grade 2 listed building into 140 units. The site is situated northwest of Bradford in a predominantly residential area with nearby access to golf course, sports center, and 2 schools. It's got some pretty cool photos. Crowd Property has now funded 400 residential property development projects worth of $700 million, funding the building of 3,000 homes. I actually have to say, this is a pretty cool development. I'm glad that Crowd Property is getting involved in that. All right, last but not least, let's talk about Trading 212. Here's the portfolio. And we've had a bit of a bump. Last time I checked, showed it on the stream, we were down in the £14,500 range. I've made this small purchase of Canadian Overseas Petroleum that has not done really well with 14.8%. I don't know if it's petrol's down in the UK, but here in the US, price of petrol has dropped quite significantly. I would say 30 to 40%. So we are in the red in that. Deutsche Bank still in the red 10%. Flex, natural gas. This thing has not been particularly kind over the last 3 months, going from 35, so dropping about 10%. So I think we were up about 40% on that, but we did liquidate some of that when the price was higher, so took some profit. And then Calera, which has done a little better. We've seen this low point where April 11th we were down at 163. Look at that. This thing has almost doubled in a very, very short period of time, like 6 weeks. So that's the reason why the portfolio has increased. And I got to tell you, I was very, very close to selling this Calera stock, and I would have been costly. And I think one of the issues about buying individual stocks is just that emotional investing problem where you just can't see recovery. If you're down 50% in a stock, you start to think, oh God, this stock is not going to come back. It's not going to recover back to where it was, even if I just break even. That stock has to come back 50%. This is one of the problems that I have investing in these single stocks is I was very, very close to taking a £1,500 loss and writing it off against taxes. And I thought, you know what, every time I do that, these stocks rebound. And I took my own cooling off period and said, no, I'm not going to do that. I'm just going to leave it. I mean, it's not a life-changing amount of money. So let's just leave it alone for the experiment, see what happens. And thankfully, from down here, we're at 160. We've seen this thing go as high as 324, so actually double. And who knows? It's a very, very volatile stock. It can go up and down 3 to, I've seen it do 12, 13% in a day. So it really is one of those set it and forget it stocks. We'll see what happens. Norwegian Cruise Line down about 3%, and then Vermilion Energy down about 38%. So, it's not great, but it's a lot better than it was a month ago, where it was 14,500. We still have some money left to punt in. I'm just not quite sure again what the play is to do with that money at the moment. I'm probably going to do some serious research next week when I have some time off and really delve into, are any of these stocks worth adding positions to? Do I think Deutsche Bank is going to recover? Probably over the long run, but do I want to put any more in here? I don't know. Not convinced about that. Banking just looks shaky at the moment, and I think this has got room to go lower. And then the energy, I do long-term think energy is going to be totally fine. So is this a play to add more to this position while being down 38%? I think that's one of the hardest things to do, right? When you see a stock going up and up and up, it's kind of mentally easy to put more money in, but reality, when stocks are going up, that's probably a time you want to be backing off it, because when everybody's piling in, look at what's happening in AI stock right now. Nvidia is ridiculous. This is just a bubble waiting to absolutely pop. We've seen this thing go absolutely buck wild from down here to 229 in March, up to 386 with, it's crazy. This is almost triple the stock. None of these AI companies are making any money, so to me that just seems like a bubble waiting to pop. But you don't want to be piling in when everybody else is piling in, because it's too late at that point. You've got to get in at that low point before everybody catches that wave and piles their money in and makes that stock really balloon. It's very dangerous to do that, and this is one of the problems with investing in individual stocks. You can get taken over by the FOMO, the fear of missing out, the hype of a stock. And nobody wants to invest in these stocks that people haven't really heard of, because there's, they want to go where the crowd's going so they can get these quick hits, which is very, very, very dangerous, especially if you're dealing with larger amounts of money. I would certainly not do that with a bigger portfolio. Just stick to fundamentals of investing. That's really what I got for you today. Let me see if you have any interesting comments, and I'm going to go pack. You'll notice too, we do not have our friend and co-sponsor Harley here today. She, alas, has been sent away for her own doggy vacation. So she'll be back in July, all being well. Richard Bindugal says the only thing is main stocks and shares are not as volatile as cryptocurrency. Rug pulls, etc., don't really happen in main shares. I would argue that rug pulls absolutely do happen in shares. I mean, not as common as what we've seen in crypto. Of course, it's completely two different sectors, but there's been some really, really big volatility. I've seen some what you consider big company shares swing 25% in a day when bad news comes out or bad earnings. I think it's been way more volatile. I get these trading 212 updates, and I've seen some stocks that are very large companies swinging in just huge amounts that make me go, wow, really 25% in one day? So, and the problem with the stock investing, there's no safeguards. Somebody can go and just pick any crap that they don't know anything about, just the same way in crypto. So not everybody goes to the blue chip stocks, right? There's a lot of people that go for small, very volatile, very risky stocks there's just nothing in place to stop them from doing that. I just don't think that that's very fair equally. Lots of complaining tonight. No, I'm not complaining. I think I'm venting more than complaining. It's okay to vent. Volcanoes vent, they have to. The pressure gets too much and they vent. Yeah, COP, definitely. I understand it's a risky stock. Interest on your cash balance. Yeah, I'm probably going to deploy it in the next week, so I'm just looking for an opportunity. Dave says I should be looking at companies that have good businesses and how they actually perform versus focusing on share price movements. Of course. Of course, but what fun would that be? I'm looking for these... I'm looking for some bigger scores. This is a trading portfolio. This is not a portfolio that is going to be made up of like 10 very solid companies that I know are going to be good in 10 years. This is a more volatile experiment. Otherwise, I'd just put it all in index trackers and wouldn't even worry about it, right? We try and get Neil Folker fourth way on the stream. I did reach out to him, and he said he would get back to me, so we'll see. All right, that's going to do it. I'm going to go pack and make my way for a very long flight. Thank you again for everybody for joining. Please subscribe. Please hit that thumbs up. I'll see you guys when I see you, if not at the beginning of July. Take a little break. Thank you again. It's great. That's all I got for you tonight. Have a great weekend. Enjoy the beautiful British weather, and I will see you very soon. Take care. Bye.